What's up, guys? Jay Martin here, investor and CEO of Cambridge House, and my guest today is Tommy Thornton, the founder of Hedge Fund Telemetry. Tommy's been on the show before. He's a crowd favorite. He's a personal favorite. I always learn a lot from this guy. This interview is going to be broken up into two parts, so if you're watching part one, look out for part two. If you're watching part two, look out for part one. We cover a ton of stuff, including how to stress test market sentiment, big curiosity of mine, and then we went into some big China discussions, which are super fascinating given the recent headlines we've seen there. So, three things before we jump into this conversation. Number one, right beneath this video, there's a pinned comment where you can subscribe to my weekly newsletter. It's free. I love writing it. I'd love to have you join the team. Number two, this YouTube channel now actually generates significant advertising revenue, which is awesome and honestly unexpected when I launched it. So what I've decided to do with that cash is donate it to an organization that is super close to my heart. They're called Zero Ceiling. Zero Ceiling's mission is to end youth homelessness. The way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas, providing them with supportive housing, employment training, and just great influences, right? The natural world can be so therapeutic and transformative. It was for me at a young age, and I love being able to pass this forward, to pay this forward. So Zero Ceiling's awesome. Check them out if you want to. Number three, if you prefer to listen to my content as opposed to watch it, you can now find me wherever you listen to your podcast. Just search for The Jay Martin Show. Okay, here's Tommy Thornton. Enjoy. I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, investor and CEO of Cambridge House, and I'm joined right now by Tommy Thornton, once again, the founder and president at Hedge Fund Telemetry. Tommy, it's good to see you. Good to have you back on.
Hey, Jay. Nice to see you too.
So the last time we chatted, we covered a lot of like investor psychology. You know, we talked about a lot of the biases that blind me as I'm making my decisions in the market, things like recency bias, conservatism bias, hindsight bias, all this stuff that like impacts our intuition behind the scenes. And I think it's really important to be aware of as much as you can. Now, I'm a real sentiment-driven investor, Tommy, and I follow people and I invest in people, and my sentiment indicators are things like Twitter, which can lead you down good paths sometimes, but also lead you down the wrong rabbit holes. So if you're connecting, I mean, you're known as, you know, a sentiment trader, sentiment investor. You have some effective tools to help confirm your conviction or maybe challenge it. How do you describe sentiment, using sentiment as a tool in the market, Tommy?
Okay, well, we've got a couple places where we can go here. First of all, sentiment to me is a condition. It's a market condition. And sentiment can stay overly bullish or overly bearish for perhaps a period of time that most people that are waiting for a turn get frustrated with. So if currently, let's say the S&P bullish sentiment on the daily sentiment index, it hit 90% and it's dropped down to 50%. It backed up to 60%. We might be having higher lows, and those are changes. But over the last 6 months, that measure, which is a very good daily measure of sentiment, was extremely overbought for 6 months. And I have not seen it like that for a long time. And it was frustrating. But I will say, I do have a bias. I can be biased short or it can be biased long. And usually I tend to go against the crowd and buy stuff, markets, commodities, currencies, when everybody is just saying you cannot be serious and you want to buy that. And I've done it a few times in my career successfully. I was extraordinarily bullish in March of 2020. Covered all my shorts and went long. Now, I hear what you're saying, that it can cause some problems with your trading if you're too bullish, too bearish. Sometimes it's good to recognize that and say, God, I'm really wrong here. It's not working. And you just limit your exposure. You take some exposure down. You have to keep moving. You can't just say, I'm going to be long this and I don't care what the market says and it's going against you. You've got to move. And, also when it's getting too bullish, take some off. There's nothing better than booking profits, and that eliminates the anxiety of feeling like you're on the wrong side, or you could see a pullback, or something could change. So I'm a trader. I will move things in and out of positions. I'll trade around them, and that helps me. Now, one thing that I tell people all the time is you have to find through your career market sentiment tools and curious type of things that happen at market highs and market lows. And it's not necessarily saying equity markets, it could be bond markets, it could be currency, commodities, Bitcoin, anything. And I can tell you, like I used to say, well, when the New York Post would put the New York Stock Exchange trader, just going like this, that was like, we got to buy, the CNBC market in turmoil thing, that when they'd run that program, it used to be a great buying opportunity, because that's when everybody is on one side. They're very bearish, and people want to hear how bad it is, or the difficulty of what's happening right now. On the other hand, let's look back in January, and GameStop was going nuts on the upside, and everybody was talking about it. The local news here in Connecticut, New York, it was like one of their first stories. It was on the nightly news, on all of them, on the cover of newspapers, magazines. They had congressional hearings on it. Even my daughter, who's in college, she's a senior in college, she called me and she said, "Hey, Dad, what's going on with this GameStop?" She's a film major, and she's asking me about this. And she's seeing these boys in her college trading it on their phones. And so I see things like that, and I think, okay, it's getting a little overdone. It's just too much on one side. Now, when you're wrong with a position, the best thing to do to clear your head is to take down your risk, take a position off. I mean, that's hard for maybe a private equity investor or a venture capital investor, obviously. But for a public markets investor, I can tell you that I know a bunch of hedge fund managers that they've just felt lost, and they say, okay, I'm just taking down exposure. I'm taking a week off. They go and they clear their head. They come back, they refocus. They can always get back into those positions. That's the thing. People, you can take losses. It's okay. That's part of the game. And if you've been in it long enough, you know when to take losses before they become something that becomes much more stressful.
Yeah. And it's hard though, isn't it? Because our resistance, like we are very loss averse as creatures. Like we're typically more fearful of losing than we are excited about winning. Right. And I think there has been some really interesting like behavioral economic studies that prove this about human beings. Right. I'd much rather not lose that than gain that, simply put. So I'll give you a real life example then. I'm pretty exposed to the commodity sector, specifically precious and base metals. And, gold price was fairly flat for the majority of 2021. I believed the setup was quite strong. And so I built positions in a lot of my favorite gold, silver developers, expecting the market was positioned for a breakout eventually. It since come down significantly. And I'm sitting on a lot of companies that I feel have very healthy balance sheets or really fantastic management, good assets and good jurisdictions. And in theory, if I like them up here, I should like them even more down here. But it's hard, right, to determine whether or not you're just failing to give up on an idea that is being proved wrong, or determining my thesis is still right, my timing was just wrong, right? And this is an amazing opportunity. I've decided it's an amazing opportunity, and I'm averaging down in a select number of these names. But when you find yourself in that position, Tommy, what do you look to help stress test your mindset?
Okay, so this is a little, I'm going to play doctor here with you. One of the problems that happens on, let's say, great value names, and gold miners and silver miners, and they're just, that's a classic value opportunity. They are well managed. They they're cheap. But the problem is you don't have any new buyers coming in. Now you could name all the big gold funds, and they basically are long. They're already there. Now gold moved. I think it was a few years ago when Paul Tudor Jones came on CNBC, and he's like, "Hey, I'm buying gold. It's going to 1,700." I'm talking like Paul. I know Paul. That's how he talks. He goes, "It's going to 1,700. It's going up. Inflation," and that brought in a whole group of people that felt confident to follow along with what Paul Tudor Jones was saying. So you had this whole new crew of people that came in, bought the miners, bought gold. It worked for a while, and then it's sort of backed off. Now, gold is precious metals are very strange these days. You've had some big moves in like platinum and palladium both ways. And gold has had these false starts, and it's just frustrating. I hear a lot of clients, I know who they are that are long, and they're like, but the thing is you're competing with Bitcoin. Now we all know we're in an inflationary moment in time. This is not something we've ever seen really for many years. This type of inflation, the amount of money that's being printed by the Fed, and it sounds so perfect for gold and for miners, but you just can't get new people coming in because they'd rather buy Bitcoin at $42,000. And that's a different hedge. It works. It goes up a lot. It goes up, it goes down. It's traded. I'm looking at gold right now. It's down 16 basis points. The GLD is down 11 basis points right now. It's Friday, the 24th. You need to attract people, and you're not going to get someone that's going to say, "Oh, I'm going to be trading GLD all day," and it doesn't move. So that's one of the things. People in this world right now, they're chasers. That's what this market is. And you have a ton of new money that's come into the market, and they're chasing what's worked. And they're chasing things higher after they move. And that's part of a sentiment thing as well. But the problem I have is with the miners and like, I know they're well managed and they're cheap. They don't work unless you have new people coming in or some really strong catalyst. And that's just been not there. And seasonality is always something to keep an eye on as well, because when they do get into their seasonal period, I think around mid-December through January, it's like perfect time to be long those. I like seasonality a lot. But one of the things that I would do, instead of necessarily averaging down, because I like to keep capital, I mean, I average up and average down, but I always have a 5% limit as far as what sizing I can do for one particular position. I would use options. So if you're long XYZ at $40 and you sell 45 out of the money, $45 call out of the money, and you get taken out of that, you just had the biggest move in that particular gold miner in months. And if you got taken out of it, you were taken out of it at a pretty good premium. And if it doesn't work, you just collected premium. I also sell puts on certain ideas. That can be a little risky. Obviously we've seen, catastrophic blowups with that strategy. But I would do like half size put option, sell a put, half size, and then a full position on selling a call. I can tell you, I've seen so many people get taken out of a covered call position, and they're just furious. I'm like, you just made money. Why are you so upset? Well, it went up higher. And I'm like, okay, well, you sold that call thinking it may not get there. And if it does go through there, you take a profit. Yeah. You got to be like less beat up. You can't beat yourself up when these things happen. I've seen people beat themselves up after taking huge gains. I mean, it's like, I wasn't big enough. So that's how I look at when I'm in a position that's not working. I mean, I can tell you, I've been short Tesla. I sell puts against my short position in Tesla every single week, and I collect premium. Why not? The premiums are so high, and you can do it. So that's a little maneuver that I do just to kind of bring in and trade around positions. And if I'm put stock and I'm buying it lower, then hallelujah. I've just bought in something I like lower, and it's at a disciplined fashion. So that's how I see it.
Yeah, I appreciate that. Those rules are so important. In addition, your 5% limit per holding. Can I ask you, Tommy, like, when did you discover what kind of investor you are, right? Because you mentioned it, we've got a lot of chasers in the market. There's a variety of traders, day traders, swing traders that have really surged in the last 18 months. Value investors like myself. When did you discover what kind of investor, and how did you discover what kind of investor you are?
Okay. It's a long journey, and you have to write down things that you do that you like. You have sort of a process and a checklist of things that you do. I have a bit of a value background. I took I passed the level 1 CFA way back. Got hired to work at a hedge fund right after, and I didn't go back, and that was fine. I learned enough. So I have a little bit of a value bent on things. I will say that I was a super bullish person through the 90s, rarely shorted stocks. I saw people that did short stocks and they made lots of money. And then 2000 hit, and I started to see the market get really dangerous. And I was hired at a hedge fund, and it was a long short science and technology fund. So we had all the favorites of, it was 2001, a very volatile time for technology stocks and healthcare biotech stocks. So I really became more attuned to being comfortable shorting stocks. So I am fine shorting stocks. I have no problem. I'm disciplined, sizing, and stops, and trade around things with options, blah, blah, blah. But I will say I went and started at a much larger fund that ended up being $5 billion. We traded so much every single day that I became very agnostic to, price and things moving in different directions. And I did not have really a problem because I had a great team around me. But when I left, I was thinking, okay, how am I going to replicate this and trade my own assets on my own? And so I have position sizing, risk levels. I have certain sectors that I tend to gravitate towards. I trade a lot of consumer. I trade a lot of energy, financials. I don't trade as much technology as you'd expect. Most people do, but I like consumer. It seems a little easier for me.
Can I ask why? Can I ask why you shy from technology?
Well, I do trade technology. A lot of times it's just the valuations make no sense to me. And I will be the first one to tell you that my performance could have been as the best performance in the entire world if I had in 2020 just held on to all of those big mega cap tech names that I bought in size. But I trimmed them, and some of them went up 40%, 50%. I thought, I've got to take some profits. We're still in a pandemic, but I've sold so many things in my life too early, and that, you tend to learn to be okay with it. I took money off the table.
Yeah.
You
can't be mad at that. You can't be mad at taking money off the table, right? And that's, it's so important. I don't know if you can learn that the easy way. I think you have to learn it the hard way, right? You have to experience the greed of a rising share price and then the skull-crushing anxiety of a falling one before you can wrap your mind around that.
Yeah. One thing that I always get questions from my clients, and they say, "Oh, Tom, I'm in this XYZ. I trade a lot of XYZ, obviously, and I've got a profit, and I don't know what to do. Should I sell it? Should I buy more? What should I do?" And I'm like, well, you could sell half. And whenever I get that, what should I do type question, I always think to myself, take some off. If you have a little bit of a doubt, and that's internal, that if you have a little bit of a doubt and you're worried that you might see a reversal and that could cause a problem, be half right, be half wrong. You're not going to you can have some maneuverability if you want to buy it back. Let's say you sell something and it goes up more, and the news taking it up higher can give you more conviction. You're just averaging that earlier price higher and you're still profitable. So it's just have that flexibility. And most people, they don't want to have that flexibility. They want to be long Bitcoin to the, a million and put all their assets in it, but they can't handle a 50% drawdown and they sell at the lows. And you have to move and maneuver around your portfolios. And look, I know a lot of perma bears. I know a lot of perma bulls, and I try to be perma profitable and trade both sides. And I'm not always right. I'm wrong all the time on things, and I get over it. I move on, and I say, well, that was kind of dumb. And I write down I have a book here where I write down all my stupid things I do. And I'm okay. I'm okay with it. It's just, and one other thing, if you're diversified and you have your sizing right, it's just money. You can make it tomorrow. If you lose it today, you can make it tomorrow. That's the best part.
If you have your sizing right, key point what you just said, right? If you bet the farm, maybe that's not the case, right? It's not just money. It's maybe a bit bigger than that. It's your livelihood. It's whatever. But if you have your rules, in this case, your sizing right, it's just money and you can make it back tomorrow, right? If you bet what you can afford to lose.
Yeah. Talking about the ranch, a very smart woman once told me years ago, she said, you always have to keep your seed money. You just, as a farmer, you can't bet your seed money on some speculative venture. I'm going to plant this and hopefully that will grow this year. You got to always have your amount of money that you trade. The other thing a lot of people do, and it's probably besides trading on margin and being overly, set up the wrong way, they tend to think that they need to make money really fast.
Yeah.
And that's the thing. And there's a lot of people new people in the market these days, they want to make money every single day. That's impossible. Sometimes you're down, sometimes you're up, and you have to, again, maneuver. And that, I think, is the hardest thing. There's a lot of people, I've seen day traders, and I know day traders that are thinking, I'm going to quit my job working at wherever, and then I'm going to day trade. And they're paying their mortgage out of this. They're paying their car payment. They're paying for all their things. And it's even worse when that pressure gets really, really high. The best investor in the world is Warren Buffett. And the reason, everybody's going to debate me on that, but the reason is he just does his process. He doesn't need to make money. He just wants to make money. He knows when to do it. He knows when not to do something, and he can sit tight waiting for that. Now, that's a nice position to be in, obviously. And there's a lot of us that want to make money every day, but don't try and make money to, have a lifestyle or pay your bills. It's very, very difficult. You got to just build and build and build. And that's my, my biggest worry when I see people that say, oh, I'm retiring and I'm going to trade my own account.
Yeah. Well, yeah, it's one of the first pieces of advice that really stuck with me was actually from Grant Williams. Things that make you go, great.
I know Grant real well.
And you must. Yeah, of course you do. And he's like, the most important thing, day one, is start to understand what kind of investor you are, right? And I took that and it was like, all right, so how do you figure that out, right? And there's a handful of ingredients that need to come into that conversation. Number one, how much time do you have to invest in being an investor? Is it an hour a day? Well, you probably shouldn't be a day trader, right? Is it an hour a week? Is it 2 hours a day? What is it, right? And that'll determine maybe how you should approach simultaneously your time horizon, right? And oh man, that was so helpful for me to sort of weather the storms. Like, for example, I invest in cryptocurrency, right? I'm not super aggressive in that world. However, I like to dollar cost average in, and I see this as a very long-term trade because I'm still not clear that anybody knows what it is yet. Right? Whether you're buying a currency, whether you're buying a speculation, whether you're buying some sort of a wealth preservation asset, to be determined. It's still 13, 14 years, not enough time to convince me, right? But because I have that decades long perspective, man, it helps when, you're down 50% on a position and you could think this has been the game plan the entire time, right? Nothing about this should be surprising. We knew this was going to occur. It's written in the reason we bought the asset and we knew this was going to, so it really, you have your book. I'd love to know what you write in your book when you say you write down all the things you do. Is this to help you understand why you're in a position or what's in there, Tommy?
I write down a lot of my personal thoughts as well, like how I'm feeling in the day. And, Denise Scholl is a friend and she does she wrote a book, Market Mind Games, and I was a client of hers. I also had a guy named Ari Kev, who was a trading psychologist that Steve Cohen hired. And then my firm hired when I was running money for my firm. They hired him. He was the sweetest man, but he had this whole thought process of, you got to know yourself. You got to know your mindset of how you're feeling. And yes, if it doesn't feel good being down 50% of something. That would certainly not make me feel happy. But if that's your strategy and you're saying, okay, I'm not, this is not my net worth here. Because if you're down 50% and that's your total net worth, you're seeing a therapist, you're taking meds. You're game over for a lot of people. It's just, they can't handle it.
Yeah.
So it's just really being honest with yourself and having that process. And Grant is right. Know your time frame, know your limits, know your strengths. I tend to not focus on my weaknesses. I tend to focus on my strengths. That's generally, I try to avoid my weaknesses. I've written down, I know my weaknesses. I know when I do something wrong and stupid, and it's usually short term. It's usually a bit impulsive. But I stay within my boundaries of how much I put into something, and it typically works out okay. But
yeah,
know yourself, know thyself. And it takes time. And the market's a tough place to learn about yourself. You can, a lot of people learn the hard way, which is really the only way you can learn of respecting risk.
Yeah. And so back to the gold market for a second, one of my rules there that I find incredibly difficult to stick to, but when I do, I'm rewarded for it. And when I don't, sometimes I'm punished for it. However, these days I'm able to stick to it more often than not is I don't look at a ton of stuff. I've identified about maybe 11, 12 names in the sector who, if you look at the long time, the essentially the span of their careers, have consistently over-delivered by a factor of 10. But it just means you have to have patience, and you're not going to get in at maybe as cheap of a price as you would on, the most exciting private placement that hit your desk today. But by consolidating in the precious metal sector, anyways, my holdings in a very few number of names, it just gives me the confidence that I can hold confidence that they're going to ride out the storm, right? I can have confidence in their decision making in good times and bad. They're going to, whatever obstacles this entrepreneur runs into, I have the confidence they've solved them in the past. Blah blah blah. Anyways, it's a hard one to follow because there's always an exciting deal that hits your desktop.
Yeah, that makes total sense. Again, my view is nothing is permanent in the market. Things go up, things go down. Things can be, you go back to Amazon, and Amazon went up 6,300%, went down 50%, then went back up to the old highs, and then dropped 93%. That was like in the first 2 years or 2 or 3 years. And if I had a humongous gain like that, and then all of a sudden it's down 93%, but I'm like, look, I believe in Amazon, it's going to be great, and I didn't sell any, you're going to have a tough time. But you just got to take a little off into gains. You got to always keep refreshing and putting money aside into the gain factor. And look, if you have a 5% position in something and it goes up to 7%, or let's say it's even higher than that, you move it back down to 5%, or you take it to 4%, and you can then, if if it dips, you can buy back to 5%. You just have to always be managing the percentage of how much you have in a particular asset. And that to me is really important. And I can tell you, I've seen people also, when I started my first hedge fund, the tech manager wanted to, this was aggressive. We were shorting Yahoo all the way down. And he's like, I want to keep a 5% position short in this thing. But like from a dollar weighted basis. And so he just kept shorting more and more and more. I was like, but it worked. And, he kept wanting to buy more long when things would go down because we're two-sided. And sometimes you got to be really careful on your weightings. And I like to look at it from initial entry and close to those initial entries on my weightings. But that's just, you can't be dogmatic and say, I've got a 20-year horizon on something when, you just got to keep buy, sell, trim, put some in the win column. That's it.
Okay, guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. But coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational, and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The Jay Martin Show.